have any, I don't know if it works.
Okay.
But someone on another Zoom call today said that there is a thing like it's called zoom.bueller.com and it will record and take notes of your Zoom meetings.
Okay.
Through AI.
Okay.
I don't know if
that
it
there's
works.
a number of people who, for example, there's a fireflies.ai note taker Rex on the call right now. I'm wondering if that's what they're doing. I'm not familiar with that level of technology, so maybe that's what some of these AI attendees to our presentations are doing. They're taking notes and recording this for their own use.
I'd like to know, yeah, if that's I'm gonna have to now Google fireflies.ai.
Well, Fireflies, I think, is their handle. In other words, that's their private handle, but we've had other people come on and I've seen their name and then .ai and then note taker or something like that. So I'm not sure exactly.
Toby, is Fireflies you?
No, that's somebody else. And because what it is they're not actually here in the meeting, but they've attended the meeting. This is like what is it when DVRing the game, right? You're not actually watching the game, but you're DVRing it.
Gotcha.
And so that's what they're doing essentially, is my understanding of the technology. Now I could have that all wrong, but somebody is effectively DVRing this meeting right now under the handle fireflies.ai, note taker Rex. And I've noticed that we have other people that do the same thing from time to time. So, and it's just okay. I mean, we're putting these kind of meetings, we're recording them anyway and putting them out there. So I'm not that concerned about the fact that they're just recording it for themselves and taking notes for them. So
interesting.
Anyway,
okay.
There's our introduction, everybody. And again, this is an informal conversation. Although I've prepared some thoughts and some presentation type ideas, again, you're free to take these discussions wherever you want to take them with your questions, your comments. It's informal, so feel free to have your camera on. Feel free to jump in and make comments. And somebody may be jumping in right now, and my internet is such that I'm probably talking over the top of them. So anyway, the previous, go ahead.
I think there's just,
it might be some feedback or something, I don't know. Anyway, the previous two presentations that we discussed had to do with the financial system, looking at the Fed, looking at the central banking system and some of the concepts and some things about monetary policy and so forth. And we finished up those two chapters in the book. They're long chapters, and we kind of summarized them more than anything for two reasons. Number one, last year about this time when we were starting this, we introduced the concepts with those chapters. And so this year, we've done it again, only this time I think we've spent a little bit of time talking about slightly different issues. In other words, there are going to be things that you'd want to go back into last year's archive and watch, and then look at this year's archive and watch, because we've had a whole year go by and we're relating a lot of things to current events, current economic events. And obviously we have a year's worth of current economic events that have happened. And so the presentations are going to be somewhat dynamic that way. But now, after we've done the first two chapters, we're going to go into secret number one, which is actually engineering risk-adjusted investment performance. And so we're going to get into more of the technical aspects again. And we went through this before. We talked a lot about the technical aspects. This year, going into it, I want to spend more time really taking some of the technical pieces apart and putting them back together again. And as we've said all along, we're not trying to make us turn people into mathematicians. Quants will be quants, right? But we want everybody to at least have a basic understanding of some of these mathematical and financial concepts so that you can at least have an intelligent conversation with the quants, right? And so I'm going to focus a little bit more on us learning some of the terms and some of the nomenclature or jargon of financial quantitative terms, what they mean, how to interpret them, how to perceive them a little bit. And again, I'm not going to do a deep dive. I don't want this to become a boring technical discussion, but I do want it to be sufficient enough that when we're talking about something or we're looking at a graph or something like that, you can have a general idea of what's going on. And so we're going to delve a little bit deeper than we have in times past. I guess that's really what I'm trying to say there. Okay, so here's our legal disclaimer. I'm going to put it up there. You can stop this and read it in depth if you want, but I just wanted to let everybody know we're not offering professional advice, and we're not seeking your investments either. Okay, so let's jump into this. This is a Ben Summers quote, and I hope I can, this screen is kind of big and we're losing some of the words there. So I'm going to, there we go. I wanted to be able to read that in its entirety. So what is risk? Jody, you want to read that Ben definition there on risk?
Sorry, I was muted.
Oh, that's okay.
Risk is a number. It's the probability of loss weighted by the expected degree of that loss. Risk is not a feeling, it's not a relationship, and it's not a story. It's a number.
Okay. This is very important because even within this community, I've noted many times Ben's frustration with people wanting to get caught up in the story of their deal. It's all about the story. It's who they know. It's their feelings about the economy or the opportunity, and they've got it in a very compelling story. And I've seen Ben time and time again ask the question, what's the risk? What's the risk? In other words, tell me the number. Tell me how you've gone through and quantified this risk. And they can't do it. And so they get frustrated, obviously, because Ben's not sold. He gets frustrated because they're not understanding. And my camera's going weird. And that's just okay, as long as everybody can hear me all right.
Yeah, we can hear you.
This is very, very important. If you've not ever heard Ben go on a rant about risk and risk-adjusted performance measures, and hopefully that rant has not been pointed at you, because sometimes
it's okay if it has been.
It's okay if it has been. You've definitely learned a lesson.
You grow thicker skin.
Yes.
He does come at a place of really truly caring about this, though. But
he does. He cares about the concept, but he also cares about the people too. Mm-hmm. As passionate as he is about a number and this concept of risk, it's just, if you find yourself getting caught up in the story and you're minimizing the number, you're gonna find yourself on the receiving end of a rather colorful rant. And so and that's just okay. Does anybody have any comments or questions about risk and why it should be a number versus a feeling or a relationship or a story?
I'll just add to that definition. It's not a pro forma.
Yes, great point, Toby. I'm glad you brought that up. He does not value forward-looking financial statements. And I'm using that as a technical term because too many accountants and analysts and even RIAs and professionals go through a lot of time and effort and money to come up with some forward-looking projections, right? When we're analyzing the future performance of something, especially something that doesn't have a track record.
Mhm.
And
And
really,
he
it's
put,
just it's a
yeah,
wag, right?
yep,
A
it's
wild ass
anybody.
guess.
Yeah, it's a wild ass guess. I'm not even sure it's a scientific wild ass guess.
That's a new term I've never heard before.
It's a
Yeah,
wag.
yeah,
Yeah.
I've
Wow.
used the term swag, scientific wild ass guess. You know,
Wow.
but the wag or the swag is based on feelings, relationships, and stories. It's never based on the number.
And
Now,
it's often based on best case scenario.
and it's often based on best case scenario because, you know, I've seen guys do this. You know, they'll say, well, here's the best case scenario, and then they'll say, but cut it in half. Let's cut it in half again. Let's half it again. You know, and they're still giving you these ultra fantastic numbers, right?
Mhm.
And so, in other words, what they're trying to say is you can't possibly lose. You know, the upside potential is infinite, and those kinds of things. Now, there are certain things that we'll talk about that show that kind of a potential, but it's not going to be based on future projections. And so the question becomes then, well, if you're not going to base this on forward-looking financial projections, what do you base it on? And of course, this is when you get into what Ben refers to as rigorous back testing. And we can go there if you want to go there tonight, but I'm not prepared to discuss it intelligently. But you know, we can have another discussion about rigorous back testing.
It's like I trade equity, so there's a process we call, well, they do a lot of back testing in trading. If you have a trading system, what it is they differentiate between subjective and objective. So objective is based on data, it's based on facts. And that's what the back testing is all about. Subjective is based on, I guess, the new term I just learned tonight, which is WAG. So that's what the subjective is based on.
Yes. And Ben does teach us the principles of back testing. So we'll be getting into that later on in the weeks to come, so that we can understand what goes into back testing and why you can rely on it better than a forward-looking projection.
I think the interesting thing, not that we're going into the back testing, but it's finding the data, you know, against the index against what you're going to measure against.
Yeah. You know, I had an interesting experience with that, Jody, you and I and Toby. We had an experience with that this last summer, where we had to go look for data, and it was quite a challenge. Just for the rest of you guys, we were doing an exercise in back testing ABL's results, Adagio's results against the return on mutual life insurance policies. And the challenge was go back 100 years. And
wow.
And so I was able to find data going back almost 50 years. I didn't get 100 out of it. And I got to a point, it's kind of funny, but I got to a point where I was so frustrated in trying to come up with data because I was extrapolating data. I was finding good data. I was interpolating data. I mean, you know, I was doing all kinds of things to try to come up with some good data to measure against and then do some serious back testing. And it was funny because I got back to I think it was 78. It was about 45 years, I guess it was. Yeah. And I got to the point where I was saying to Toby, if they want me to go back further, they've got to give me the historic data because I can't come up with it any other way. And quite frankly, 45 years, in my opinion, was more than adequate as far as going back in time. So I thought, you know, if they want to go back to 1920, then that's fine, but they're going to have to give me the data to test. And so I stopped at 1978. Anyway, so there's some good lessons we've learned there, and and it was a fun project. That was the one that Ben looked at. He said, I'm not going to look at it, or I'm going to end up spending hours going over this, poring over this. And it was funny because he was talking to us. The next thing you know, he paused, he stopped, and he goes,
And he had to
"Oh,"
see it.
he goes, "Oh, I looked at it."
I couldn't
mean,
help myself.
It was almost like he was confessing to watching porn or something.
Gosh,
I looked at
Wow.
it, darn.
Frenchie.
Man.
Hey,
Couldn't
you guys, I
resist.
tell you, when I came on, and I apologize for last week, but what was that link you guys were posting in the chat about
Oh,
oh man, I saw, I'm like, well, wait, what are you guys talking about
We
here?
had several
you
links.
read
I'm
it?
not sure I remember which
Oh,
one.
I don't know
Are you
if I
talking about
wanted to
the-
read it. I didn't have a chance to, but I saw it and I was like, no, that can't be true.
it was fact
Oh.
checked.
Wow, that's crazy.
That's a
Yeah,
fact checked article.
You
I
talking
haven't
about
read
the
it yet, but I'm gonna read it.
WEF, World Economic Forum?
Yeah.
link
Somebody
that
actually
Jody put
said
out?
that.
Yeah.
Oh,
Klaus Schwab.
You kidding me? And what happened? They didn't check him on that?
Well,
No, it was an
apparently not.
opinion.
That's
It's an opinion
Yeah.
that he was voicing. So there's no fact check to be made other than the fact, did he say it or not?
Said it.
I guess,
Yeah.
yeah. So if he fact
It's a
checked
white-
it, yes, he said it.
it's a white paper, and I have not gone to the depths of perusing their website because it usually just makes me mad
Yeah.
to find the white paper. But I mean, their whole agenda is depopulation. And in that article, they
Mhm.
said, well, what's another way we can depopulate the earth? Well, let's
Wow.
terrorize kids.
Yeah.
Then they won't want to have kids.
Yeah.
You know what?
It's-
There was a society that was, and I think it was, I don't know, I don't know if I recall it correctly. There was a group, and I'm not sure if it was based around, I don't know if they had a monument that was something similar to Stonehenge, and their whole philosophy was to control the population.
Yeah, there's a lot of statements that have been made on that, and
Yeah.
and they've been fact checked as to whether or not the individual made the statement, and they did. But again, we're talking about that individual's opinion. I don't want to minimize what they're saying and doing. I think it's sick, but and so it's being said. But yeah, these are twisted ideas that some
But
very
I think the bigger
influential
point
people have come out with.
yeah, and I think the bigger point to that though, Mark, is the people that are behind it, that are funding it, in essence, are us through the companies that attend that
Yes.
Davos and through
Mhm.
BlackRock and the banks.
Yep. And I think that's why a lot of companies and government pension plans and things like that are basically saying we want to be divested of some of
Right.
these banks and whatnot that are participating in those kinds of things. That's why Rick DeSantis, the governor of Florida,
Mhm.
said, or Rick DeSantis didn't say it. I'm sorry. It was Florida's chief financial officer. So it was Rick
Right.
DeSantis's number one finance guy was basically saying we're divesting ourselves of anything related to BlackRock, just because
Oh.
they're so fundamentally opposed to the political influence and the political weight that BlackRock is throwing around. And so,
Wow.
But
Yeah.
then we as consumers, and we have to start thinking too of what we're buying, because you shut down the money and you shut down a lot of stuff.
yeah.
And they're in control of 90% of it. So
Yeah. So that's why, I believe, and I feel that, I don't know where Ben is exactly on some of those kinds of issues, but I do know that he has, he comes from the Austrian School of Economics, which has a very, very strong libertarian bent politically. Most Austrian economists are libertarians politically, as opposed to, a Chicago school economist who is going to be mainstream Republican, right? Or a Keynesian economist who's going to be a socialist in their political bend. And so, you can't, I'm not going to say you can't not mix politics with economics. It's just that you do, right? And so, And so, I suppose Ben could be a social liberal and be an Austrian economist, right? But it's not likely. And so my thinking is that he probably shares some of these more, I'm just going to say libertarian ideas. I'm just guessing. But
I
you know,
think regardless of political party, most people find pedophilia disturbing.
repulsive. Yeah, sick,
Yes.
twisted.
But they're trying to normalize it.
Yeah.
That's the agenda. And I find that totally disturbing. So I'm like, wait, what? So when when you hear all these people, I saw someone that posted a link on LinkedIn. She's like the top person at Goldman Sachs. Just got back from Davos. I want to post that article on her LinkedIn and say, really? Did you know this is what you're supporting?
Yeah, really.
Exactly. Yeah, exactly.
Anyway, that
Okay.
was, sorry, we're way off the topic.
That's okay.
Sorry,
I don't
Mark.
mind rabbit trails at all.
Hey, Mark,
can you being
switch
very
to presentation mode on your presentation?
The only problem is in recording this, a lot of the pictures from the Zoom
We're losing you.
meeting cover up the graphics and the words. I can try it again. Let's see. Okay, so there's the presentation mode.
Okay.
All right, well, let's continue on and we'll just go where this takes us. So here's the next slide we want to talk about. We want to talk about smart money versus dumb money, or the odd lot theory. And again, I'm going to take it off presentation mode so we can see the whole thing. But there you have the
well, we can see it,
detailed
Mark.
definition. You can see it okay?
Yeah, we can see the whole thing. Yeah.
Okay, great.
In presentation mode, we're fine.
Oh, you can see the whole thing. Okay, because
Yeah,
I'm
we can.
recording this and I'm covering up part of that. All right, so I'll bring it back then, and hopefully it won't.
Oh, I see what you're saying.
On your
because
side,
I've got
on
on
your
my
side,
side that I'm recording that I'm. It's got pictures and names of attendees and stuff like that, and that's what's covering up the pictures and the slides. So
What if you changed your view on, anyway?
it doesn't matter from slide to slide. I have to move the pictures around. So I mean, I could do that, I suppose. I can slide these down and we can read it, and then. So there we go. That I'll just keep moving it around that way. So anyway, we're talking about the smart money versus the dumb money, and the dumb money is also known as the odd lot theory. Does anybody want to take a second and explain their understanding of smart money versus dumb money?
in the short term, it's institutional versus retail.
Okay, that's one way to describe it. Okay. Anybody have any others? Okay.
Wouldn't it,
Go ahead, Jody.
is that what Ben, in his, is this the 1% versus the non 1%?
You can try to quantify it, and it's probably pretty close. It might even be less than 1% versus the less than 1%. Basically, the way Ben defines it, and I pulled these definitions here out of the book, he says that the smart money is able to proactively manage risk. In other words, you're going to come in and say, what's the risk? And risk is that number rather than the story. Okay, so if you're looking for a number to manage risk, you're probably more on the smart money side of the scale. Let me just say this much: when you're talking smart money versus dumb money, it's a sliding scale, because as I look at this section here, I've looked at my own investing practices, and I thought to myself, am I smart money or I'm dumb money? And I've got to confess, I'm probably dumb money more than I'm smart money. Simply because there's probably a lot more that I could do to analyze the portfolios that I mimic. I tend to mimic a lot of portfolios. I'll go in and just to give you an idea of what I've done now. I've never done this particular one, but I've done similar things. But I'll go in and I'll take a Warren Buffett stock portfolio and mimic it. And there's a lot of people that do that kind of thing. They'll look at what he's invested in, and they'll look at the weight of a particular investment versus other investments that he's invested in, and they'll set their portfolio up to look just like his based on what amount of money they might have. Of course, they don't have a billion, they don't have billions of dollars like he has, but let's say they have 100,000, and so they'll look at his portfolio. I mean, his portfolio is publicly shown out there. You can find it. And they'll say, oh, well, he's got X percent of his money in this. He's got Y percent of his money in that. And he's got Z percent of his money in Bitcoin or whatever, or commodities, or different kinds of things. And so they'll take their portfolio and they will mimic his portfolio. Some people, and I've done this, they will take and they'll subscribe to a like-minded what I call a like-minded prognosticator of the market. So for example, some of you might know Jim Rickards, or you might know Nomi Prince, or other famous prognosticators. These are people who analyze the markets. They look at it from an economic standpoint. They look at monetary policy coming down. For example, Nomi Prince is talking a lot about what the Fed is doing right now and how as it's raising interest rates to slow down inflation, how that affects the markets and how it creates distortions in the market and those kind of things. Great stories, right?
Mm-hmm.
But she's not measuring risk. Okay. But man, can she tell a great story. And it's a lot of good analysis. Now, a lot of her people, her analysts that work behind the scenes in her newsletters probably do manage some risk. They do quantify risk to some degree. I'm sure they do. But, she's making recommendations and she's not showing them what the risk adjustments are, right? And so because I'm subscribed to her newsletter and I'm just simply blindly following her recommendations, then that still keeps me in the classification of dumb money because I'm not proactively measuring the risk and looking at it in the context of everything that's going on. Like I said, she might be, but I don't know. And because I don't know, that still keeps me in the category of dumb money or odd lot theory, because I'm just simply buying retail based on her recommendation more than anything. Now, I like to find newsletter prognosticators who are contrarian investors. So that helps a little bit if you follow that concept. But all said, unless you're proactively managing that risk, or know for certain that it's being done, and you're able to have some intelligent thoughts and conversations about that, then chances are you're not in that 1%, as Jody said, or whatever that percentage is, and you're now falling more into the odd lot theory, which is over here. And there are individuals who are considered such dumb money that many professionals regard them as contrary indicators or odd lot theory, or the lemming-like masses. And so, I make my own confession here simply because I want to be able to illustrate the difference here. Those two schools of thought, I guess, is the best way to do it, and allow you as individual investors, allow you as fund asset managers, allow you as Celeste. She's chasing dogs. Okay. Anyway, to just look at your own practices and ask the question, am I functioning like smart money or am I functioning like dumb money? And then you can kind of adjust accordingly going forward. I know that as I get more and more into the asset management side of things, even if I decide to consider some of these newsletters that I've subscribed to in the past, and I've done very well by most of them. There's a few of them that I won't do again, but as a general rule, I want to be able to say it's smart money because I personally have gone in and tested that portfolio. I've gone in and tested the performance, the historic performance of those assets before choosing to put money into them. And so
when you get a chance, there's a site called Whale Wisdom.
Whale Wisdom. Okay.
Yeah, go to there. That gives you, it's a site that follows all the big institutional, the big heavy funds, all the big major heavy duty funds like Simmons and what's his name? Icon.
Oh, Carl Icahn.
Yeah, Carl Icahn and all the big ones. And they do a summary, and then they give you I believe they still give you a list of like some of the stocks that they invest in. Because I mean, all the big funds have to report. They have to report to the SEC. So they have to give an account of what stocks and stuff they buy.
And a lot of those large institutional funds now, I believe, are probably subscribed to something like Aladdin. And the good news about Aladdin, even though it was developed by the villains, it was based on risk-adjusted performance measures, risk management. Yeah. And so, from that standpoint, you got to say, okay, Aladdin is okay. Aladdin's good in that sense. It's just what they're using Aladdin for is not good. But the point is Aladdin is within the banking industry is very ubiquitous. It's being used by just about everybody. And so I don't know where I was going with that, except to say that I lost my train of thought. So I'll just let that go for now. I'll probably say it later
no
on.
problem. Yeah, and a lot of the endowment funds, like the Yale endowment fund and the Harvard endowment fund, their whole philosophy, their whole thing is based on risk adjusted investment.
Oh, and
Exactly.
a lot of them are in alternatives.
Yeah, and that's one of the reasons why I emphasize, and Ben emphasizes this later on in the book, and so we'll go over this later on. But risk-adjusted performance measurement, the way Ben is promoting it, is nothing new. It's just that so few people actually use it and use it properly. Yeah, and that's what he's really beating the drum for.
There's a reason for that, though, Mark.
Go ahead, Jody.
They'll never change it.
That's true. That's true.
Because the house always wins.
Yep.
I mean, how many people put how much money is in mutual funds? People think that's that's what you do.
That's the best way to invest in the stock market.
Right.
Yeah, and it's not. And it's unfortunate. People being sold that dream. And they're eating it up like it's water. I mean, it's a shame what they do to people.
Well, that's the whole idea there is that the guys that are, promoting the mutual funds are basically saying you're managing your risk a couple of ways. I mean, this is how they talk about risk management with mutual funds, right? So let's understand it for a second. One, you're diversifying your portfolio among a multitude of assets, stock assets, right? And depending on the conservative nature or the aggressive nature of the fund, you're still spreading it out amongst a bunch of different assets. And so they're basically saying that's risk management, because if one goes down, your whole portfolio doesn't go down. Okay. Well, that's true, but it's not complete. Another way they say you're managing your risk is the old concept of dollar cost averaging. Anybody familiar with that term? Have you ever used that term, selling, investment products with life insurance or mutual funds or anything like that? And the dollar cost averaging basically is as the price goes up, you're buying fewer shares
Yeah,
So you're not taking as big a risk when the price goes down. You're buying more shares, and
right.
so you're taking advantage of the lower cost, and and that's a risk management tool.
Yeah,
But those two alone are not enough to manage your portfolio. And I'm going to cite as data for that right here on this page, going back to the 2008 financial crisis. The Dow Jones lost 54%, and some people have never recovered. The S&P 500 lost 57%. So
Mm.
that's what dollar cost averaging and diversification gets you.
I tell you,
You know.
I tell you a story. A quick story. One day, it was my wife, my ex-wife, my son's mother. Had her. We were meeting with her, one of her. I guess I don't know it was one of her advisors, her financial advisors, that was handed down to her from her father. And he was with American. It was the other hand of American Express. I think it's American Financial or something like that. And we were going over her account, and at that time, that year, the market dropped, and I think she lost about like 30 or 40% in the account. And I was pissed off. I was upset. And I said to him, I said, well, listen, because I'm thinking to myself, I could do better than this myself, because I was, and learning at that time, I was still learning and trying to develop my own system. And I said to him, I said, well, listen, how do you protect the fund when you get a drop like this? I mean, don't you have people that when you see the market going down, don't you get out? I mean, what do you do? And he couldn't give me an answer. So he looked at her, he was getting pissed. And then, he didn't even want to, and then he sort of like made a statement like, well, it's not really your point to say anything about it because I'm dealing with her. And I was like, and I said, okay. I said, okay. So he sort of like leaned to her, and she sort of like leaned on with him, like, well, like, oh, he's taking care of it. He'll handle it. But she was believing in him because her father was using him, and he did okay.
And that's where you get into the principle of nobody cares about your money more than yourself. You can't rely too much on other people.
Exactly. And I was like, wow, this is crazy. I said, and you can't even question them when something goes wrong. You can't, I mean, I know I was dealing with him.
Yeah, he feigned caring, but he doesn't really care.
Yeah. He's trying to do his job. He's trying to keep his job, that type of thing. And then when you question him, I mean, he doesn't have an answer. So what is he going to say?
He goes on the attack with an ad hominem attack.
Exactly. Yeah. So I was like, okay, so that's the way it is, huh? I said, okay.
Well, and that's part of the problem that I had, Frenchie, because I'm in insurance right now. And, I got my Series 6, which is totally a waste of time. But the only thing that you can really offer are like a mutual fund. And I'm like, but I don't want to do that. So I sold nothing because I'm like, this doesn't really help. And then we were told so far as you're not allowed to ask anything about their financial picture.
What?
And you want me to sell
how do you offer
products?
somebody? Yeah, how do you offer somebody something if you don't know what their situation is?
Exactly.
Wow.
So that's why the whole thing was a waste of time.
It's amazing.
It's amazing. Jumping back over onto this for a second, I want to, and again, these rabbit trails are great. I loved listening to them, and I also loved to comment on them. So I'm not discouraging them at all. Yeah. But I will bring us back around every once in a while.
Yeah, thanks, Toby, for posting that link. Thanks.
Something that Ben talks about, and I don't recall if he talks about it here in this point in the chapter, or if he talks about it later on, but I'm going to bring it up just to bring some value to the conversation. And that's where Ben introduces the concept of efficient versus inefficient markets. Okay. In efficient markets, such as the stock market here, the Dow Jones, the S&P 500, the HPI, those are considered efficient markets. And of course, you've got these losses here. The key or the point that he makes with respect to efficient markets is that this is where the true concept or principle of the risk-reward trade-off works. In other words, the higher the return, the higher the risk. The greater the risk, the potentially higher return. But again, people aren't measuring that risk, so they really don't know how to maximize the returns. I mean, think of it that way. If you can't quantify risk, how can you quantify return? And so, especially when there's a direct correlation between the risk reward trade-off. And again, that applies to efficient markets. When we're talking about the alternative assets, and he is lumping real estate deals that typically have been syndicated in the past, he's classifying that as an alternative asset. In other words, when you talk about assets that are not in the markets as efficient markets, those are alternative assets and they're considered inefficient, then the concept of risk reward trade-off no longer applies. And so that's why it's that much more important that we focus on risk adjusted performance measures, because that's how you're going to calculate your risk and your potential reward. And so I just thought I'd insert that little discussion point there. And again, just, here he's kind of taking a step back into chapters 1 and 2, talking about the 2008 financial crisis. So, he's quoting Ben Bernanke here, where he says September and October of 2008 was the worst financial crisis in global history, including the Great Depression. And so there's one Fed chairman's view who lived it, I guess, who is looking at the financial crisis. And like I said, he's going to go back and give a little bit of a nod to chapters 1 and 2 by talking about financial crises. It portends of things to come, and because 2008 financial crisis now is very well documented. We all have studied it. We all can talk about it very from an educated position, right? The point is, and we've talked about this in depth in other presentations. We're now standing on the brink of another financial crisis. In fact, I believe historians looking back on 2021, 22 particularly will say that's when the next Great Depression began. Right now, for political reasons and for political expediency, everybody's in denial, and they always are in the beginning of these things, trying to protect the Keynesians and whatnot. They're saying, oh no, times are great. They'll see how Biden mumbles through that one tonight, right? But anyway.
Oh gosh, is he on TV tonight?
Yeah, he's doing State of the Union.
Yeah, that's right. Yeah. What time? Does anybody?
9 o'clock Eastern.
Okay.
9 o'clock Eastern. And I'm not even going to bother to watch it. I'll watch the pundits talk about it tomorrow. But anyway, the point is that, having studied, we've all studied 2008. We're going to be studying 2022 here in the not too distant future. And a lot of us are trying to apply those lessons. And Ben does a great job in the book, by the way, applying the lessons of 2008 to what's going on right now. And it's like ripping, even though he wrote the first edition of this book 8 years ago, just came out with the second edition this last year. He's been ripping, headlines out of today's newspapers and putting them in his book. And so it's going to be very, very apropos to what's going on. And so
well, what is he predicting?
It's definitely worth
You're frozen.
Reading this book and getting into the meat of it to understand. Basically, let's go here and look at what he's predicting.
Oh,
that was a good segue.
Yeah, right.
basically we look at 2007 to 9 and we talk about the Great Recession, right? The point is, sweetie, I'm in a meeting and we talked about this. Remember, we can't interrupt. You got to be quiet. Well, calm on. There you go. Okay. So anyway, the thing he wants to point out is that we have very short-term memories. And that if we were to take a realistic look at the timeline, even going back 40 plus years, you can see that we've had some kind of financial crises that's affected the market significantly about every 10 years.
Yeah.
And they keep getting bigger and bigger and bigger. It's kind of like, throwing a stone in the pond back in 1980. And now by 2023, the ripples are getting pretty dang big.
Well, isn't it in proportion with the size of the market though? I mean, is that
possibly the size of the market, of course, is part of it, but it's also the way that you sweep the problem under the rug, the way that you handle the problem. Yeah, the size of the market is partly responsible for that, but it's also how they handled the previous problems. And if you go back and look at each one of these and study them independently, but then also look at them together, you'll find that the mistakes, if you want to call them mistakes, I don't believe in mistakes, but the metaphorical sweeping under the rug tends to bring the problem back worse the next time and worse the next time. And it's more than just the size of the market. It's the fact that they didn't take care of it the first time around. Let's take an example of 2008. 2008 was just a massive bailout. Okay. And we had this philosophy that these banks were too big to fail. Okay. Because we took the approach of the massive bailouts, and you look at the price tag of that, not only was it a bigger price tag than the previous bailouts and the previous crises, but this next time around, those same entities now are going to want bailouts again, only this time exponentially larger bailouts. Because they didn't learn the lessons from the last time. And so, yes, the size of the market, the growing market is a part of that. But I think a lot of it also has to do with, if you put your own personal financial situation out there and take an individual who gets themselves into a bankruptcy situation, and then they're able to file bankruptcy, but they didn't learn the lessons from the bankruptcy. So they went out and even borrowed more the second time around. And 7 years later now, or 10 years later, whatever it is, they're wanting to file bankruptcy again. And they didn't learn their lessons. And so they go out and borrow even more and more. And I don't know of anybody who lives that way from bankruptcy to bankruptcy, but you can imagine that if they didn't learn those lessons and they don't do it right, and they just keep getting forgiven, they're going to go, wow, that worked. Why don't I do that bigger next time?
exactly?
And so that's essentially the same kind of attitude, but just transferred into a economic mindset rather than an individual a macroeconomic mindset versus a microeconomic mindset, say. So I hope that made sense. So you're right, it is the size of the market, but it's also other things as well, having to do with just mindset and, wow, we got away with that one. We dodged that bullet. Let's see if we can dodge, a hail of bullets. And at some point in time, you can't, you're not going to be able to. If it's just the growth of the market, then the market will also keep deferring the inevitable, as it were. In other words, if we were growing ourselves out of these, then even though each crisis got bigger and bigger, you still would be able to overcome the problem, in that sense. But, we're going to reach a point, and I think this is going to be it, where not even our Federal Reserve Bank will have the ability to bail out the banks that they're bailing out.
Yeah,
And
well,
so
wasn't that the purpose of the Dodd-Frank? Because that's why the banks were able to survive the small one, the recent one we had, because their bank sheets were in order this time because of the Dodd-Frank, the changes in the Dodd-Frank bill. So they had to make sure they had the reserves.
Dodd-Frank, I think, is like, well, I won't give you a metaphor, but I'll just say it's too little, too late.
Okay, well, it's pretty much basically what you're saying now.
It'll have an impact. Don't get me wrong,
Yeah.
and the intention, I think, was good, but if you go back and look at the history of our legislation is always reactive. It's not proactive.
Yeah, exactly.
And because the problem is endemic to the system. Okay, what I mean by endemic to the system is the problem is the Federal Reserve. Okay, the problem is how we have structured our economy based on debt, and a debt-based currency rather than an asset-based currency. And so we've shifted, and so it's the fundamental flaw in the system itself that is causing the problems, and therefore, because of that, Dodd-Frank or any other reactive legislation can only have a limited impact on preventing these things from happening again in the future. In other words, Dodd-Frank sounds good when you say it fast, but it's not going to be enough. And
Hey,
so,
Mark,
go ahead.
on that end, the next crisis, do you think it'll play into the the CBDC?
That's
what I was thinking. That was going.
I think that will be a part of it, and that's going to be interesting because I have watched the doom and gloomers talk about what's going to happen if we put that CBDC in place. I've watched the people, the soothsayers, say, "Oh, that's not ever going to happen." But the fact of the matter is,
it's already happened.
It's an Overton window. If you understand that concept, it's an Overton window, and it's already happened.
Well, what does that mean?
An Overton window is, how do I explain it? I'll use World War II. I'll use the Jews in Europe as an example during World War II. They had what's called a normalcy bias, okay? Which basically the Jews would say, well, yeah, we had Kristallnacht, but it's not going to get that bad. And so they rationalize staying, even though they were encouraged to leave. Then they began putting Jews in ghettos. Well, they're making us live in the ghettos, but they're not going to get any worse than that, right? It's this normalcy bias. Oh, well, they can't get that bad. Before you know it, they're now in concentration camps. Well, they're not going to kill us, and they're not going to perform medical experiments on us and things like that. They just kept moving this Overton window over and over and over until before you know it, there's 6 million people killed.
How the politically unthinkable can become mainstream. Is that what it is?
Yes, how the politically unthinkable can become mainstream. Now, the reason why I tell you that this is going to happen and why the doom and gloomers with respect to the CBDC should be believed is because it happened during COVID. Okay, go back on COVID and look at what people said should happen and the things that did happen. When COVID got politicized, and I think everybody understands what I'm talking about, politicized. You had a group of people then pointing the fingers at another group of people, and it doesn't matter which direction you were on the issue. Okay, I'm not talking about that, but I'm talking about the extreme consequences that people were against the other side. Whether you believed COVID was a real pandemic or not, whether you believe there ought to be a jab or not, all those kinds of things. You can remember, and they were bringing this stuff out. I mean, you had people in Congress saying, "Oh, we need to do this to those who are anti-jab," and they were talking about things that were unspeakable, even including concentration camps. And you think, oh, they'd never put him in a concentration camp. That may be true, but you had congressmen and women calling for it. And if they're calling for it, it is possible.
Well, I mean, if you
Okay?
look at what's
Because those
happening in China
extreme
with it,
ideas do take root and happen. Yeah.
I mean, in China,
yeah.
they're still quarantining. I mean, they're literally putting people in camps.
Yeah. Take a look at what happened in California during COVID. And, and you had, again, major political upheaval over whether or not which side of the issue you were on, but you had a group of people in power in California that were literally persecuting the other side, and they were doing everything they could to disenfranchise. And I don't mean just from a voting standpoint, but disenfranchise these people to take their rights away because they were on the wrong side of the issue compared to what the majority wanted. Well, that's mobocracy. I don't know if you guys have studied politics, but that's mobocracy. Okay? When the majority can now persecute a minority because they have a difference of opinion. That's a mob. That's not politics. That's not democracy. That's not a republic. That's pure mobocracy. The opposite of that, it was defined by Benjamin Franklin. And I'm sorry, we were talking economics and now we're getting into politics. But Benjamin Franklin defined democracy or mobocracy as two wolves and a sheep deciding what to have for lunch. That's democracy. Liberty is a well-armed sheep contesting that vote. And that's, I'm quoting Benjamin Franklin verbatim. They understood back then, over almost 250 years ago, that it was human nature in a crisis of any kind, economic, political, or otherwise. In a crisis, number one, majorities can be swayed. They can be influenced. They can be deceived into believing something. And that's exactly what happened in COVID. Okay.
Sounds like
now
Facebook. Sounds like Facebook.
Facebook, Twitter, exactly. You get social media and you can now sway millions and millions of people to think and act a certain way. Yeah. Okay.
Hey, Mark, I apologize, but I got to run. I got 7 o'clock.
Okay.
But you're recording, correct? I hope.
Yes, I am.
Excellent. Okay.
Did I record? I hope I recorded.
Yeah, it looks like it.
Yeah, I'm recording.
You're recording.
I'm recording. Yep. Okay.
All right.
Good.
You guys have a good evening. Enjoy it.
Thanks, Frenchie.
Yeah.
And
Bye.
all right. And Mark, this is a perfect talk because I was saying to myself today, I was going to ask you, what's the quickest way for me to get up to speed on what what you call is doing with the fund, and this is the subject we're talking about. So it was perfect for me tonight. So I appreciate it very much.
Okay. Well, you're welcome, and thanks for all of your participation tonight.
Okay. Thank you, guys. See you guys later.
Bye, Frenchie.
So we're coming up here on about an hour. Yep. And so I'd like to kind of go through some of these other slides real quick. There's not a lot left, but I wanted to spend some time going into an introduction to risk analysis. As I was kind of teeing this up earlier tonight, I said we're going to dive a little bit deeper into some things tonight. So we are going to do a little bit of math, but not a whole lot. And it's probably math you can pretty much do in your head. But I wanted to talk about the basics of risk analysis. And we'll spend more time going deeper into this into the future as well. So in the book, Ben introduces the coin flip. This is the first introduction to risk analysis, and we're going to talk about flipping a coin. And so, here's an example where, he talks about, all right, you want to invest, you want to bet invest $1 on a coin toss, and you want to bet $1 that it's going to come up heads or tails, whichever way you want to bet it, red or black, whichever way you want to bet it. And how to calculate what a fair return on that would be. Okay. And so the calculation of the fair return is taking your investment, dividing it by your odds, and we'll define the odds because there's a sub calculation in there. And that then becomes what a fair return would be. So, when you're looking at an investment opportunity, you're going to be looking at a similar formula. Now, obviously, the formula is going to be much more complex because you have other dynamics, number of variables going on, and so forth. But it's going to be the same concept. It's what would be a fair return on my investment. A lot of people come in and say, well, I want to put in, $500,000 in your company, and I want over half the company. And you're looking at that and you're going, well, my company's worth more than $1 million, and so obviously neither the investor nor the investee at that point really understand how to calculate risk and give a fair return to the individual who's invested. And so they just take a swag at it. There's that word again. And, and oftentimes, huge mistakes are made. So let's look at this coin flip. So if you're betting $1 and there's how many possible outcomes on a coin flip? 2, right? Heads or tails. And so you take 1 divided by the number of possible outcomes, which in this case is 2. So 1 divided by 2 is 50%. So you take 1 divided by 50%, and that equals 2. So if you wanted to have a fair return on an investment such as a coin toss, then basically you're looking to double your money based on the amount of the sorry, my wife is calling me, but I'm going to let her wait. That was Mom. If you want to call her back. So anyway, that's kind of how a coin toss would work. So I said, let's play with this a little bit more just to make sure that we get this concept down. Let's turn it into rolling dice. So what do? We have a roll of the die. So there's 1 die. They're not 2 dice, just 1. What would you do? Okay, you take the same formula. Let's say we're betting $1 on the roll of the dice. What would be a fair return if you got it right? So you've got 6 possibilities, right? So your odds are 16 2/3% chance of getting it right. So if you bet $1 against a less than 17% chance of success, then that works out to be $6. Okay, so there's an example of the same formula, different medium there, a die versus a coin. So now if we're really starting to get our heads around that kind of a formula, then let's look at it this way. Let's talk about a lottery ticket. Okay, so if we've got a lottery ticket, let's play with this. We know what the fair return is going to be because let's say they state they're gonna give away $25 million. Okay. Sometimes in some lotteries, depending on how many people are betting on that lottery, that Powerball may go higher and higher and higher. But in this case, it's $25 million. And so we look at the odds to win. And so in this case, we're saying, there's 175 million people all buying lottery tickets to participate in this lottery. So what is your odds to win if you bought 1 ticket? You take 1 divided by 175 million, and it gives you that percentage right there, 0.6057%. Okay, very, very low number. And those zeros mean that essentially your risk of losing is 0.99999943% chance of losing. Okay, you're gonna lose. But the question is, what is the fair price of the lottery ticket? So in other words, we're just simply doing the same formula as we did with the coin toss and with the die roll, same formula, just in reverse. Because we didn't establish what the fair price was, we determined what the fair return was. But using algebra, you can do the equation in reverse. So in this case, you divide. There's a couple of ways to get to this, but the easiest way to do it is you divide 25 million, which is the fair return, divided by your odds to win, and it's 14 cents. Okay. So now the question you would ask is, all right, if the 14 cents is the fair price, why are you buying the ticket for $1? Toby, why are you buying? I see your head nodding. Why are you buying the ticket for $1?
Well, I'm not. I win $1 every time I don't play.
Yes, as my dad used to say, the
You're freezing up on my end.
He's freezing on my end too. I wanted to hear what Mark's dad says.
lottery is a tax on the stupid. But
Lottery is a tax on the stupid. That's what I got.
yeah, that's what I got too. Uh-oh.
At least he froze with a smile on his face.
I know, right? What a great way to freeze. I'd freeze and look stupid.
Yeah.
okay,
That's-
somehow I got bumped off, and I think we're still recording.
We are.
If not, I'll splice them together or something. But let's get my screen back up here. Oh, I can see now. Hold on. I got to fix my internet connection. It bumped me off. Okay. Okay, let's try this. Anyway, are you following the math? Any comments on the math here? Does that make sense? Okay, so there's two things going on with the other 86 cents. Okay, since I was asking about the dollar. First of all, $1 is not a fair price. A fair price is the 14 cents in terms of giving you the risk that you would want to take in that lottery. The 86 cents that you're paying above the fair price, you know, people will say, well, that goes to cover the cost of the lottery. Obviously, they're raising money for whatever great cause they're raising money for, and that's coming out of the 86 cents. But from a standpoint, stack house. Okay, if you were if a MGM Studios, not MGM Studios, MGM Grand in Las Vegas was holding a lot, and it was just all the people putting their money into the lottery, and you bought this lottery ticket for $1, and they have playing. That's how they stack the odds in the favor of the house, by creating an unfair investment or an unfair return. If you go back, for example, to the die roll, since that's Las Vegas, right? What they'll do is they'll say, okay, you'll bet $1, and if you get it right, you pay out, your payout's 5, or your payout's 4, or your payout's 3. Okay. And a lot of people go, wow, I invest $1 and I could get 3 back. All right, I'll play. But is that a fair return? No. And that's how the house can keep winning. And that's how you stack the house, stack everything in the favor of the house. Okay. They don't have weighted dice. So it's the house is manipulating the equation. Okay. And so that's how you stack the odds in the favor of the house. And you hear the old saying, the house always wins. That's how they win. It'll be an unfair investment in relation to the unfair return. Okay. And so if you were a casino in Las Vegas or on the Mississippi River, and you had anything other than this fair equation, you wouldn't make it as a casino. You'd lose money. You'd go out of business, right? Because everybody's going to win. Everybody but the house. So that's how the house stacks it in their favor. Just thought you guys might want to know that. Okay. Any questions or comments at that point?
That's just what I always say, Mark. The house always wins.
The house always wins. That's how they do it. Like I said, if the house had a lottery, they would charge $1 for the ticket, run it just like this, and they would pocket the 86 cents profit. Because, you know, one person's going to win that 25 million, but you've made 175 million in sales, right?
Why didn't we think of a lottery?
Yeah. Okay, so let's go on and take another look at a risk from another perspective. Okay. Ben talks about the soldier's bad bet and tail risk. And so this is now moving us more into the statistical analysis of risk, because we're going to talk about skewness and kurtosis. Okay, and those are two technical terms that are conditions at the moment of risk, as Ben will say. And we're going to talk a little bit about that so you can kind of visualize it. But we're going to talk about it in the context of the soldier. So as you know, a lot of people go into the military thinking that, oh, this is going to be such a great deal because they're going to pay for my college. They're going to be, you know, giving me all these kind of benefits. I can't enumerate all the benefits because one of my biggest regrets is I didn't take them up on this offer. So I didn't do military, and I appreciate those that do. But there's a lot of promises and guaranteed things, you know, the money that they're going to make, and, you know, the college that's being paid for, and the housing, and, you know, all the kinds of benefits that accrue to these people, and it's well deserved. And so they look at this guaranteed benefit, and then they, you know, because the upside potential is guaranteed, but it's finite. You know, there's only so much college they're going to take. There's only so much housing that they're going to provide. There's only so many bonuses they're going to get. Okay. The downside risk has two elements to it. Number one, the downside risk is they're going to go to war and they're going to die. Okay. There's two elements to that downside risk. One is the likelihood that they're going to go to war. They may go, you know what? There's no war going on right now, so my risk of having to go to war is very, very low. You know, they sign up and the next day somebody declares war, right? But even though the downside risk of them going to war is very low, the risk of what could happen in that war is infinite, meaning they could die. And so, you know, they're putting a lot more on the table when it comes to risk than even they realize. Okay, and there's two elements to this. And this is what we're talking about with respect to skewness and kurtosis. So let's look at skewness and kurtosis. Here we go. So this is the soldier's bad bet, and what's called tail risk. So if you look here on the left, this is what's called a normal distribution. It's just the normal bell curve, right? Statistically, everything works out. There's no more positive risk than there is negative risk. There's no more likelihood of either a positive outcome or a negative outcome. Okay. Now let's look at this curve on the right. Okay. This distribution is called skewed, and it's skewed to the left, which means it's skewed to the negative. And so if you're looking at the risk that they're taking, the soldier, all of the good benefits that they're going to get that are guaranteed are on the right side of that curve. Okay, so that's all the free college, that's all the housing, it's all the other bonuses, it's everything that they're going to get, it's all the medical benefits that they're going to get throughout their lifetime, and so on and so forth. And you say, okay, that's your upside potential. It's guaranteed. okay, which means the kurtosis of that curve is negative. Okay, if you look at the height of that curve right here, and we're going to talk about that a little bit more, but look at that height compared to the height of this curve. Okay, so a low height means that there's a low risk of not getting that positive outcome. Okay, the probability is of getting that outcome is guaranteed. Okay, but now you look at the left side. This is the possibility that they're going to go to war and that they could even die. Okay, and so you're looking at that, and you know, and if a soldier looked at that curve the question where, you know, if they understood the statistical application of that curve, they sign up. Is that such a good bet? Yeah, you're gonna be guaranteed all of this, but what is the risk that you're taking? You're taking all of this risk. That's your potential downside. Okay. And again, the likelihood of that risk is low. There's your kurtosis. But if that becomes the reality, look at what you're risking by going to war. Oops. Okay, so I'm going to jump off of that. We're going to go look at this. So let's convert that skewness. This is what's called skewness. When you look at this, it's a skewed distribution.
Did he freeze on you, Toby?
And so that's called skewness at a moment of risk. You the other direction is yes. It can left. I'm sorry.
Mark, I think we're getting like every other word. At least I am. Maybe it's on my end.
I don't know if somebody had a comment there or you cut out. I'm going to show you an example. Okay. It might be on my end, although I'm not frozen up, so I'm working. But anyway, if it's skewed to the right, that's a positive skew.
And there he went. You could almost tell he was like going,
Yeah.
gone.
Yep. Oh, well, how are you doing?
Good. How are you?
Good.
I'm freezing. I'm sick of this weather. Aren't you?
Yeah.
Yeah,
Okay, I'm here.
he's back.
So was that making sense?
Yeah.
Yeah.
But we were hearing every other word towards the end.
But we saw the slide.
Yeah.
Sense at all? Okay. Okay.
You're still.
So real quick, can anybody think of that has very little downside risk and almost infinite upside potential?
Investing in Adagio's products.
That's what I was getting ready to say.
Buying shadow banking.
That's great. What's another one? Okay. Yeah. What's another one?
Using options.
Options. That's a very good classic example. And so now you want as an option that has a low kurtosis as well as a large right flanked skewness, right? So you want something that's going to go way out here on the right from a risk standpoint, but have a relatively high. Sorry, I'm still learning kurtosis. So that's what the next slide is going to talk about. Okay. So those are your two curves from a skewness and a kurtosis standpoint. So with respect to skewness, the cost is high if it's negative. In other words, you got infinite costs. The cost could be infinite. That's like in the soldier's case where, his infinite risk is death, right? And in the case of options or adagio products, the reward is high, so it's going to be positive, other direction from a statistic standpoint. And then kurtosis now, the height, not the length. So skewness is the length of the curve, kurtosis is the height of the curve. And so if the probability of an outcome is high, it's positive, and if the probability of the outcome is low, it's negative. And so what you want in John, something that's way out there to the right and with a very high curve.
Mark, you might want to cut it until your internet's back. I don't
Yeah,
Does
think
that
it's-
make
he's gone.
sense?
Oh, no,
this isn't going to be a very good recording.
no, it's not.
Say, for example, oh, am I there? Am I back? Am I back? Hello?
You are
You're
now.
back. But yeah, your
You
recording's not
weren't.
going to be good. I would end it and pick up here on the next one.
Can you hear me?
Now we can.
Can you hear us? Read your chat.
There he goes again. I was getting ready to tell him in the chat. We were only hearing every other word.
Yeah. I don't think he's looking at the chat when he's.
It's kind of
Presentation.
hard when you're doing the presentation because you can't see everything. But
I was wondering if he is connected directly to the internet using Ethernet, or is he using Wi-Fi?
I don't know. He's been having lots of
must be Wi-Fi.
problems recently.
Okay, I'm back. Can you hear me okay?
Yeah,
Yeah, but your recording's going to be pretty bad because we can only hear like every other word.
like probably the last, was it 2 or 3
Oh.
slides, Toby? He was
Yeah.
going in and out.
Yep.
We were putting that in the
Okay,
chat.
well, I might have to go back and just record this separately and put it up there as kind of an auxiliary video to this. Anyway, the last slide I had here was the socialization of risk. And again, it kind of goes back and touches back into what Ben talked about in the first 2 chapters, which is the Federal Reserve socializes risk, meaning that all of the risky things that the big banks do gets passed on to the taxpayers. And that's documented in the book Creature from Jekyll Island by G. Edward Griffin. And I found another book that was written in 1912, U.S. Money Corporation Currency, The Aldrich Plan by Alfred Owen Crozier. It's a book you can get for free in PDF form on the internet. So you just copy that into your search bar and it'll come up. He was an opponent to the Federal Reserve Act of 1913. And so he wrote this book in 1912. It's almost 500 pages. This guy went into intensive detail in terms of what was wrong with the Fed before it ever came about, what we were risking as a country, as an economy in the world. And so, even though he's talking with much lower numbers, you could have ripped this right out of the headlines again. And yet the book is over 100 and almost 111 years old. And so it would be well worth reading and understanding. So anyway, that's all I have to really say tonight as far as what's going on. I encourage everybody to go back and reread the parts of the book that introduces risk analysis. Go back and reread the coin flip, the lottery ticket, and the soldier's bad bet, and look at those things from the perspective of skewness and kurtosis. Because Ben will drop those words all over the place, 50-cent words, and it's important probably for you to at least be able to visualize when he says skewness, what he means by skewness, and be able to visualize kurtosis, what he means by kurtosis. Because those, and understand them so that as you're talking about risk-adjusted performance measures, you can visualize a curve that says, oh, this is the curve for this option is going to look like this. Remember, because he does talk about options. The curve for this particular back testing population looks like that. And you can kind of mentally visualize the curve. And it helps describe the kind of risk that you're taking. So that, heaven forbid, if you find something that has that, big tail risk there on the left-hand side, no matter what good story they might be telling you, to stay away from it. So, because they'll have a whopper of a story, or they might, say, hey, I've got an inside track with, the Fed chairman. But when you test the data and it comes out skewed to the negative, to stay away and not get involved. Because sure shooting, that's how it'll roll out.
Hey, Mark, I have a question for you.
Yeah.
Have you had a chance to look over Ben's white paper yet?
I haven't.
Haven't either.
I haven't.
Because that's supposed to be a tool, right, that we can use
Yes.
to
What
do
he's
this
done,
on anything, right? Like,
yes. And what he's done is, I have looked it over enough to know that basically he's put the formulas for the different statistical moments of risk, the formulas for coming up with a risk-adjusted performance measure. And I believe that for the most part, they match what he does on that page where we were doing the spreadsheet analysis and we were incorporating all those measurements, how to do. And I've got to study his
Losing you again.
quadrant a little bit more closely. Conclusions.
uh-oh.
Pros.
Performance measures, but I don't know what to do. Probably ought to wrap this up and I will try to come up with, like I said, region of the analysis part.
Uh-oh, there he goes again.
Okay, well, I'm going to just
Oh, there he is.
say good night.
Hey, John.
Yes, I'm here.
Yeah, we can connect on Tuesday when we're doing the lab next week.
Yes, we can definitely do that. I am definitely looking forward to all of how this all comes together, because this opportunity to upload tonight, that would be fantastic.
Okay, I'll get this put up as fast as I can along with the others, and then we'll go from there. John, if you need some assistance from me before next Tuesday night, just holler, just email me or message me on school, and we'll connect and go over what we need to go over. I apologize. I'm just fighting this internet so bad tonight. I think we better say goodnight.
Yes, if there is a contact you could share tomorrow,
Yeah.
I've got a call. I mean, it's not going to be mission critical tomorrow. I know, what I'll be sharing, but definitely, we'll definitely want to talk because I want to get Ben plugged in here as quickly as I can, and I'm not going direct because I love what you're doing and I ultimately want to be your client for that done for you solution. So we'll have the testimonial as to how we took this opportunity and brought it into, I think, really a very elegant form and function based on what you've been sharing.
Right. Okay. I look forward to doing that. I just put my email address up in the chat. And so I think just about everybody else has it, but I'm sure you have it there.
Yeah, unfortunately, I had to go out on the road, so I am. I'll circle back with the message on school.
Oh, okay. I'll email it. I'll message it to you as well.
Fantastic. Thank you so much.
All right, guys. We'll catch you on the flip side. Take care. Bye-bye.
Bye.
Bye-bye.